So here we go. This is the Gorman Group, a financial planning services firm owned and operated by Nicole Gorman as of October 31st, 2019, the end of the fiscal year. So just so you know, maybe you've recognized already, not all companies use a calendar year as their fiscal year. Like the college, our fiscal year ends in July. And it makes sense for us to do that because really our revenue cycle starts up in the fall semester and runs through the end of the spring semester. So that's why we use that as our fiscal year. So this group does October as the end of their fiscal year, and it gives us this adjusted trial balance, which I've copied over on the right to try to make our lives easier as we start to do the work. So there it is. We've got $1 million. Are your numbers the same as mine on this one, or are they different? Yes, same, everybody? Same. Okay. All right, so the first thing it wants us to do is to prepare an income statement. So when we have an adjusted trial balance, we have all the info we need for an income statement. And an income statement is going to summarize revenues and expenses, right? Because that's what income statements do. So I can look on let me get my picture out of the way here. No one cares about me. I mean, I am particularly handsome, but you can just look on the natural thing. You don't need to see the video. All right, behold my beauty. Revenues. So as I look through, if I remember how my trial balance is designed, I have assets, followed by liabilities, followed by stockholders' equity, then dividends, then my revenues and expenses. So my revenues will be right here. I usually just look for these credit balanced accounts about usually something like a little more than halfway down the document. That's how I zero in on them quickly. So I see that I have service fees of $468,000 and rent revenue of $5,000. And then my expenses, they're going to be right below my revenues. So they'll be over here, starting with salaries and expense and working down. So some people like to go through and like put all of the account names in first. That's fine. Some people like to put in the account and then its balance and so forth. Like you can do it either way, whatever makes you happy. So my salary expenses were $291,000. My depreciation expense on equipment, $17,500. My rent expense was $15,500. Salaries, no. Supplies expense, $9,000. Again, it tries to trick you by giving you supplies as an option. Remember, supplies is an asset. Supplies expense is an expense. Utilities expense of $8,500. Depreciation expense on buildings of $6,600. Repairs expense of $3,450. Insurance expense of $3,000. And then miscellaneous expense of $5,450. So I think just to make it easier, once I have all those in there, I'm going to just go full screen so I can see these total columns over here. Again, if you were looking at it full screen, you would have seen them the whole time. So to get total revenues, I just add up my service revenue and rent revenue, and that's going to give me $473,000. And then to get my total expenses, I won't try to do that one in my head. 291. I got 360,000. And then my net income will be my revenue, 473,000 minus my expenses. When would I put net loss there? Yeah, good. Is that what you said too? Okay. Yeah, so if your expenses are higher than your revenues, then you have a net loss. If your revenues are higher than your expenses, you have a net income. All right, I'll double check my work. Make sure I don't carry any mistakes down into the next section. That looks lovely. So next, I've got to do my statement of stockholders' equity. So I have to carefully read these instructions. It says during the year, no additional common stock was issued, which would then lead me to believe that the common stock balance on this adjusted trial balance is the same as it would have been at the beginning of the year. Does that make sense? If no more common stock was issued. So I'm going to say balance at the beginning of the year. Common stock would have been 25,000. Because that's what's here on the adjusted trial balance. And then retained earnings is also going to be what was on the adjusted trial balance. What's on the trial balance represents the retained earnings at the beginning of the year, because we haven't yet closed the accounts to move any new net income or take away any dividends from the retained earnings. So our retained earnings was 195,000, which I think means our total is 220,000. All right, then we're gonna take a look at our net income. Our net income will not change our common stock, but it will increase our retained earnings. We just figured out our net income on our income statement. It was 113,000. So retained earnings will go up by 113,000 based on the net income. And then our dividends, which we can look right here on our adjusted trial balance. They were 20,000, and that's going to reduce retained earnings. We'll put in a negative 20,000. And then we'll have my balance at the end of the period, so October 2019, which is going to be common stock of 25,000, retained earnings of 195,000 plus 113,000 minus 20,000, 288,000. And my total stockholders' equity will be 288,000 in retained earnings plus 25,000 in common stock, or $313,000. And I can check my work. It looks like all of that was correct. Yeah.
Just quality of life thing. If you just click in the center of that window and then hold Control and then the minus button, it should zoom out. That's a good small.
Again, that's, well, yeah, that does seem like an improvement, so thank you. Can you guys still see it from where you're at? Yes, in the back. Trajan, you're the furthest away, so can you see that screen? Yeah. All right. Okay, so we're on to our balance sheet. Our current assets. Remember, this is listed in asset order. It's also listed, or in balance sheet order, it's also listed where all the current assets are grouped together. So really, we're just going to go down the list. We have cash in our current assets, accounts receivable, prepaid insurance. Wait, supplies, and prepaid insurance. Those are our current assets. Remember, current assets are assets that are cash or readily convertible to cash within the next year, or consumable items that will be used up, that we expect to use up in the next year. Okay. And again, we just take our balances straight off of the adjusted trial balance. So I've got 11,000 in cash, 28,150 in accounts receivable, 6,350 in supplies, and 9,500 in prepaid insurance. And add those up. Total of 55,000 in current assets. Property, plant, and equipment, those are our longer term assets. So they start here. I have land of 75,000. I have buildings of 250,000. Less accumulated depreciation on the building, which is 117,200. I'm going to actually show that as a negative. And then the buildings minus their accumulated depreciation are the book value of the buildings. So I'll just take 250,000 minus 117,200 gives me 132.8. Then I have equipment, cost of 240,000. I have accumulated depreciation on the equipment, which I'll put as a negative, 151,700. So the book value of my equipment will just be its cost, 240,000, minus its accumulated depreciation. So I have 88,300 is the book value. So the total of our property, plant, and equipment is just going to be the 75,000 for land, plus the book value of the buildings, plus the book value of the equipment. I get 296,100. And then our total assets will be our total property, plant, and equipment plus our total current assets. There we go. So there's our total assets. You got to scroll over to the right to see our liabilities and stockholder equity section. You guys doing all right? You need me to slow down, stop for a second so you can get caught up or go back to any of the parts? What? I got lots of quietness. So sometimes people are quiet because they're good, and sometimes they're quiet because they don't want to look like they're behind or something. All right, so our liabilities. They're going to start right after the equipment. So our current liabilities are accounts payable, salaries payable, and unearned rent. Remember, current liabilities are liabilities that are short-term in nature and that we expect to pay off in the next year. So it's pretty normal. Like accounts payable is like when you buy stuff from a supplier and they give you a chance to pay later. They don't usually give you more than like 30 to 60 days. So you would expect that that's constantly being paid off. Unearned rent, you don't usually pay more than a year in advance, right? Salaries payable is usually resolved by the next payday cycle. All right, so our accounts payable had a balance of 33,300. Salaries payable, 3,300. Unearned rent, 1,500. Add those up. Total liabilities are 38,100. Remember our stockholders' equity, we're going to pull that right from the statement of stockholders' equity that we just created, or I think their schedule, whatever they called it. So that will include our common stock and our retained earnings. So we got to do a little scrolling here. Our common stock was 25,000 and our retained earnings was 288,000. And those two added up to, what was it, 313? And then finally, our last line on the balance sheet is our total stockholders' equity and plus our total liabilities. So 38,100 plus 313,000 gives us 351,100, which should match our total assets. It does. And so we feel joy in our hearts. Did you guys feel it? Yeah. So now it wants us to journalize the entries that were required to close the accounts at October 31st. So again, a reiteration of the accounts that we close. We call them temporary accounts, and those are the accounts that have to return to zero for a new accounting period. And that will be revenue accounts, expense accounts, and dividends. Those are the only accounts we close, okay? So what we're gonna do is, since the revenue accounts, if we look on our trial balance here, our revenue accounts, service fees and rent revenue, they have credit balances. So in order to close those accounts, we'll have to debit them. So I'm going to debit service fees and rent revenue, just the amount of their balance. So service fees had a balance of 468,000 credit. So I'm now going to debit that account, 468,000. And rent revenue had a $5,000 credit balance, so I'm going to debit that account, 5,000. Right, that act right there will return those two accounts to zero. My expenses all have debit balances, so I'm going to credit each of those an amount equal to their balance. So that includes salaries expense, depreciation expense on equipment, rent expense, supplies expense, utilities expense, depreciation expense on buildings, repairs expense, insurance expense, and miscellaneous expense. Again, these all have debit balances, so we're going to credit the same amount to bring their balance to zero. 291,000 for salaries expense, 17,500 for depreciation expense equipment, 15,500 for rent expense, 9,000 for supplies expense, 8,500 for utilities expense, 6,600 for depreciation expense on the buildings, 450 for repairs, 3,000 insurance, and 5,450 on miscellaneous expense. Okay, so now that I've done this, do you think my debit and credit columns are balanced? Like they're going to equal each other? No. So what will be the difference between them? It would be the net income, right? Now I could go through and I could just add up both sides and then figure out the difference. But I know if I just put my revenues on the debit side and my expenses on the credit side, then my balance is going to be a debit, right? Because I have more revenues than I had expenses, of equal to the net income amount, which was 113,000. And so what are we going to do with that net income? Where does it go? What's that?
It goes up there.
Yeah, but where? Thank you. What happens to retained earnings when we close it? I mean, what happens to net income when we close it? It goes to retained earnings, right? So we're going to, and so retained earnings is a stockholders' equity account. It increases with a credit. So by putting retained earnings and crediting the amount of net income, we now have a fully balanced entry there. If we'd had a net loss, we would have had to debit retained earnings, which would have reduced our retained earnings. Okay. So really what I'm doing is putting in all the revenues and the expenses, and then the difference between them closes to or goes to retained earnings. And if we have more revenue than expenses, then we'll have an increase or a credit to retained earnings. And if we have more expenses than we have revenues, then we'll have a decrease or a debit to retained earnings. Okay, so there's our closing entry to close all revenue and expenses out to retained earnings. And then the last thing we have to do is close out our dividends to retained earnings. So dividends have a debit balance of 20,000. So to close them, we're going to have to credit dividends 20,000. And we'll debit retained earnings. We can see from this that that net income increased retained earnings with a credit, and that dividends decreased retained earnings with a debit. Last question asks us, if the balance of retained earnings had instead increased by 115,000 after the closing entries were posted and dividends remain the same, what would have been the amount of net income or net loss? So first of all, I guess for me, I had to break down what did happen. What did happen is is my retained earnings account increased by 113,000 and decreased by 20,000 from these closing entries, right? So the net increase was, what is that? 97,000. So that's what did happen. Does that make sense? So now what it's asking me is, what if it had instead increased by 115,000, but the retained earnings stayed the same? So instead of this happening, I had still 20,000 decrease because of the dividends, but my increase, my total increase was 115,000. What would have been the net income? That's what they're asking me. Okay. And so really, I mean, that's pretty easy math. I would just say it was 135,000. I would have had to have a net income of 135,000 if my dividends were still 20,000 in order for my retained earnings to increase by 115,000. So it should be 135,000 net income. And there we go. That's it.